Hey everyone, thanks for tuning in, and today we have an exciting episode on a heavily requested topic, credit cards. We'll go over what they are, how they work, the traps you can fall into, and how to pick the best card for you. We've seen those little plastic cards all the time, we use them to buy things, and now we even have them on our phones. But what are they really? A credit card allows you to borrow money from the bank to buy things. It sounds simple enough, but there's quite a bit that goes into this. Firstly, the bank charges you no interest on the short-term loan they are giving you for a certain amount of time. It's usually always 1 month. After that 1 month grace period is over, you'll get your credit card statement from the bank showing everything you bought, how much you need to pay back, and most importantly, when you need to pay them back. Ideally, you pay them back in full. The bank gets their money, you get to buy things and pay for it later, and there's no interest charged on the loan now that your grace period is over. Win, win, win. If you don't pay your balance back in full, then you should be very careful about the interest charges coming your way. Say you bought some groceries, you bought some clothes, you bought some gifts, you paid your utility bills, and your statement was $1,020. The bank will allow you to pay back the entire balance, or you can pay what they call a minimum payment. So you can pay a minimum payment of $20. So that's right, on a $1,000 bill, all you have to pay is $20 this month. However, they're not doing this out of the goodness of their heart. They're going to charge you interest, a fee for giving you the loan every day until the full amount is paid back. Yes, credit card interest is calculated daily. To continue this example, say the credit card has a 20% annual interest rate that they charge you. If you divide that by 365, then you're getting charged about 0.05% every day on your balance. I know that may seem like a very small number, but you're going to see quickly how it can get out of hand. So after your 30-day grace period is done, you get your credit card statement and need to pay the balance back. If you don't have the full amount, the statement will say, hey, you can just pay this minimum amount right now. So in our example, it's $120 to clear your balance, and the minimum you have to pay is $20. So if you pay the minimum balance, you have $1,000 left that you need to pay. The next day, we can call this day 2, you're going to be charged that small interest amount on your $1,000 remaining balance. So the interest you owe on day 2 is 55 cents. On day 3, you're going to be charged interest again, but it's not going to be on the $1,000. It's going to be on the new balance, the $1,000 55. And then that fee is another 55 cents. So on day 4, you're getting charged the interest again, but it's on the $1,000 plus the 55 cents from day 3 plus the 55 cents from day 2. Again, this may seem like very small numbers, but after 30 days of not paying, you would go from $1,000 to $1,016. That's $16 of interest that you have to pay in only 30 days. To continue the story, say in the coming months, you still didn't want to pay off the full $1,016. Instead, you're just going to stick with the minimum $20 payments like you've been doing. This means it would take you 109 months to pay off this statement. That is 9 years. And over that 109 months, you would have paid $1,200 in interest. That is more than what your original bill was for. Where interest charges can get really dangerous is if you buy things while you already have a balance outstanding. So going back to the example, you paid your 20 bucks, now you owe $1,000 to the bank on your Visa bill. Day 2 goes by and you pay that 55 cents of interest. Now say on day 3 you go out to buy some more groceries. On day 6 you go to the movies. On day 20 you buy a gift for your sister's birthday. All regular purchases that you'd make over a course of the year. All of those amounts would get added to the money that you already owe, and then you would be charged interest on those. So at the end of the month, you would owe $18 in interest. That balance would carry over to the next month, and then the interest would calculate again on that. That was $18 of interest where we only purchased 3 things. Imagine a regular month where people buy things nearly every day. It can be a very bad and scary cycle of not paying the balance in full, because then you keep owing interest, but you need to buy new things to survive. Then you get a bigger balance, so then you keep owing interest. Keep in mind, you don't need to wait until your statement to pay off the bill. If you have the money, you can pay it off immediately and stop the interest. Well, this may sound very small. It's just $16 a month. It's just $18 a month. In 1 year, you would have paid almost $200 in interest. That's 20% of what you're owing, and that's assuming that you didn't buy any other purchases either. Credit card interest rates are some of the highest you can have, so it's really important to be responsible with them, or you can find yourself in some debt and heavy interest charges really quickly. So then the question becomes, if credit cards are so scary, why do we use them at all? For starters, they can help you build up your personal credit score. By showing the banks you can pay your bills in full and on time and time again, you'll be able to get bigger loans in the future, say for a car, for a house. Secondly, depending on the type of car that you use, you can get rewards from them and even earn money and trips by using them. So we've covered what credit cards are, the dangers of them, why they can be useful. Let's go about how to pick the right card. There are generally 4 different types of credit cards: a no rewards card, a cashback card, a travel points card, and a low interest rate card. A lot of beginner credit cards have low limits where you can only spend $5,000 or $1,000 a month on them, and they're generally directed at students. These cards offer no rewards, but they are designed to help you understand and how to use credit cards responsibly. The second type of card you can get is a cashback rewards card. This gives you a flat % back on everything you buy. A card may advertise you get 1% cash back on everything you buy, and sometimes you get more cash back on essentials like groceries and gas. Usually the amount of cash back you get can be capped out, so make sure that you read the fine print of the offer. Travel rewards cards are exactly as they sound. As you buy things, you accumulate travel points, which you can redeem for flights and hotels. Say for every dollar that you spend with the card, you get 5 points, and a flight to New York may cost 20,000 points. A lot of these cards also give you welcome bonus points when you sign up, but you need to do the math to make sure that you're actually going to get enough points to go somewhere that you want. Finally, the last card is a low interest rate card. If you are going to keep a balance on your card, like in the example, these cards have a lower interest rate than traditional cards, so that the interest that you're going to be paying will be lower. Cards with better perks oftentimes have an annual fee, which sometimes you can get waived depending on if you have a checking or savings account with the bank. If you have a no rewards card, I highly suggest that you switch to a cashback card or a travel points card, because this is free money or travel that you are missing out on. There are lots of tools online that help you compare credit cards in your respective country, and I suggest that you take a look at it and find the one that works for you. To conclude this episode, I just wanted to hammer home, it is very important to pay your credit card in full as soon as you can, once the grace period is done, to avoid paying crazy interest charges, and to pick a card that gives you some type of reward. Well, this wraps up for today's video. Remember to like, comment, and subscribe to the channel. Thanks for watching and have a nice day.